Welcome to the Pro Ticker Deep Dive. We are jumping straight into what everyone is calling the AI Capex super cycle.
Right, and the industrial build-out that's coming with it.
Exactly. You've given us this incredible stack of sources mapping it all out, and our mission today is, I think, pretty clear. We need to figure out who is actually footing the bill for this multi-trillion-dollar infrastructure.
And maybe more importantly, what the real limiting factor is now.
Yes. Is it still a fight over silicon, or has the main constraint, moved somewhere else entirely?
It's a great question, and I think the answer is that the constraint has fundamentally shifted. If you synthesize all these reports, you really see four dynamics defining the next, say, 24 to 48 months.
Okay, let's unpack this. Give us the four dynamics.
First, CapEx is scaling at a pace that is, well, it's almost irrational. It's much faster than any near-term visible revenue can really justify.
So the hyperscalers are making this huge bet. They're building way ahead of the curve.
They have to. Procurement lead times are getting so long, and capacity has become intensely strategic.
That strategic nature is absolutely key. If you're capacity constrained, you could lose a multi-year customer to a competitor just like that. But wait, if capacity is that strategic, why isn't silicon still the #1 issue? We're hearing about chips everywhere, all the time.
And that's the critical shift. That's dynamic number 2.
Power.
Power. Power is rapidly becoming the binding constraint.
Really? Faster than land? Or even GPUs?
Faster than both, especially in the major build-out hubs. The timelines for grid interconnect and just delivering the physical equipment, those are now the gating items for turning new capacity on.
That implies a major shift in where the investment focus is going to go.
Exactly. Which brings us to dynamic 3. ROI is morphing into a portfolio problem.
What do you mean by that?
It's no longer just about the revenue from one specific AI service. The strongest paybacks might actually be indirect.
Like internal productivity gains, that kind of thing.
Right. Productivity, employee retention, platform lock-in. It's about securing the entire ecosystem, not just selling one AI product.
Yeah. And the fourth dynamic. This has to be about who actually benefits from this spending spree.
It is. The fourth dynamic is this shift in the second-order winners. Phase 1 was all about the chip makers, no question.
Of course.
But the next wave of massive upside, it's accruing to companies involved in power distribution, advanced cooling, and critically grid equipment OEMs. The winners are defined by the new constraint.
That sets the stage perfectly. The sheer magnitude of what we're talking about here is hard to get your head around. This isn't just another cloud expansion cycle.
No, this is a global industrial build-out. It rivals historical infrastructure projects.
When we look at the numbers, some analysts are forecasting over $1 trillion in AI infrastructure spending in just the next 5 years.
And that's just the AI-specific part. If you zoom out to the total data center landscape, the base case estimate for cumulative CapEx, it's projected to hit something like $5.2 trillion by 2030.
$5.2 trillion, that is absolutely staggering.
It is. It implies these assets are being built for operational lifespans measured in decades, not a few years.
Okay, let's unpack that investment. Who is actually writing these enormous checks? Our sources highlight this just exceptional level of spending from the big hyperscalers.
The scale is immense. Just look at the top 3. Microsoft targeted roughly $80 billion for AI-enabled data centers in its fiscal 2025.
$80 billion.
Then Alphabet, feeling the pressure for Google Cloud and Gemini, raised its 2025 CapEx outlook to between $91 and $93 billion.
And Meta's not far behind.
No, Meta guided its 2025 CapEx in the $70 to $72 billion range. This is an investment arms race, pure and simple.
And what's fascinating is that this isn't just one type of purchase, like buying GPUs. The sources break this down into 3 distinct CapEx layers.
Precisely, and that's why the ownership structure is starting to fragment.
Yeah.
We can think of it in 3 layers. Layer 1 is the IT equipment itself.
So the accelerators, the networking gear, the memory.
Exactly, all the fast appreciating assets. This is still dominated by the hyperscalers, the Microsofts, Googles, and Metas. They own this layer.
That's the high-risk, high-reward compute core. So what's layer 2? The building itself.
Layer 2 is the data center facility. The physical shell, site prep, power distribution inside the building, the cooling plants. This layer is now increasingly shared.
Shared with who?
With colocation developers and digital infrastructure REITs. They'll fund and build the facility and then monetize it through these incredibly long-term leases. We're talking 10, even 15 years.
And that leasing market signal is just incredibly strong. I saw one source noted that 74.3% of the capacity under construction in North America was already pre-leased in the back half of 2024.
It's the strongest signal of sustained demand we have. I mean, they're locking in these assets before the foundation is even fully poured.
A race to secure power and land.
It is. Which brings us to the final layer, layer 3. This is the time to power or grid layer.
So this is everything needed to get the power to the site.
Right. The interconnect substations, high voltage transformers, all of it. And this layer is fundamentally different because it's funded mostly by utilities and grid OEMs.
And their funding model is different because it's regulated, right?
Exactly. Utilities operate under regulated cost recovery. They fund these massive slow-moving projects, knowing they'll recover the cost over time through their rate base. The whole AI trade is now part tech, part infrastructure, and part energy play.
We see the hyperscalers and the big funds driving this. But what about, the traditional enterprise customer? Are they suddenly building their own AI factories?
For the most part, no. For them, it's an OPEX story, not Capex. They pay for cloud consumption. They buy access to AI services.
So their own Capex is very selective.
Very. It only makes sense if they have a really specific need, like data sovereignty or ultra-low latency, or maybe a super predictable inference workload that justifies the upfront cost.
So the path for most corporations is hybrid AI. Rent the big training capacity, but maybe keep some critical inference on-premise.
That's the model. But if hybrid AI is the future, we also have to look at this new breed of competitors, what people are calling the neoclouds.
You mean players like xAI with that massive 2-gigawatt project they're planning in Mississippi?
Exactly. That project is estimated at over $20 billion. These new players are using a classic project finance playbook.
So asset-backed financing against contracted customer demand?
Yes. They're bypassing the standard hyperscale model, but in doing so, they're taking on all the classic infrastructure risks, execution, project completion, demand volatility.
We've established who's paying, but let's get to what I think is the most pivotal insight here. The limiting factor has decisively moved from silicon to power. Why is this AI Capex wave so fundamentally different?
It all boils down to physics, really. It's about rack density.
The amount of electricity consumed per server rack.
Right. A traditional rack might have been, 5 to 15 kilowatts? Today, these high-performance AI racks are commonly running at 40 to 130 kilowatts, and they're going higher.
A 10x change in power demand in the same physical space, that's a massive challenge.
It changes everything. It means entirely new electrical designs. It drastically limits where you can even build these things. And critically, it makes liquid cooling mandatory at scale.
Wow.
I was reading this one anecdote about how fire suppression systems are struggling to keep up with the heat density in some facilities. It makes the physical reality of this shift very visceral.
And that spike in density, it translates directly into this monumental global energy demand.
It does. The International Energy Agency, their projections show global data center electricity demand more than doubling, going from about 415 terawatt hours today to around 945 by 2030.
That's a non-linear demand curve. It's accelerating.
It is. And if you just look at the U.S., some projections suggest data centers could be consuming between, say, 4.6% and 9.1% of all U.S. electricity generation by 2030. That requires generational grid upgrades.
Okay, so if power is the absolute constraint, what's the most critical bottleneck in the supply chain right now?
This is the surprising part. For today, it's not actually the generation capacity. It's the equipment you need to step down and deliver that power. We're talking about large power transformers.
The big ones.
The big ones, and the high-voltage switchgear. Multiple reports confirm the lead times are extreme, anywhere from 80 to 210 weeks.
Hold on. The average lead time cited by NEMA, the National Electrical Manufacturers Association, wasn't that around 120 weeks?
It is.
That's over 2 full years.
2 years, minimum. And that's a massive delay in the critical path of a multi-billion-dollar project. The time to power can now easily exceed the time it takes to build the actual building.
So you could have a $100 million building finished in 18 months, but it just sits there empty for another year because the transformer hasn't arrived.
That's stranded CapEx risk at the highest level. And you can't solve it with more money or software. It requires heavy manufacturing capacity that takes years to bring online.
So given the scarcity, how are the big players responding? They can't just be waiting in line for 2 years.
No, they're becoming, in effect, massive energy portfolio managers. They're doing huge long-term power purchase agreements, or PPAs.
To lock in prices and meet green energy goals.
Right. And we're seeing serious interest in baseload contracts, even nuclear. Meta has been public about pursuing long-duration nuclear agreements.
What about bypassing the utility queues altogether?
For speed of power, yeah, they're increasingly looking at on-site generation,
Yeah.
installing gas turbines, for instance, to generate power locally.
But it's not just the equipment, is it? You mentioned pushback earlier.
Yes, community and policy pushback over things like water usage for cooling or noise pollution, that's becoming just as material a constraint as the equipment shortages. Getting that social license to operate is now a key part of the process.
That environmental angle brings us neatly into the ROI puzzle. The cost is staggering, the build-out is constrained. But why are investors demanding so much more measurable proof of return this time around?
It's the utilization profile and the asset depreciation. Classic cloud demand was pretty predictable. AI Capex is massively front-loaded. You buy the expensive GPUs today. But the revenue is usage-based and can be very bursty.
So what's the one metric that determines success or failure here?
It all comes down to capacity utilization. The whole game is about keeping this expensive, fast-depreciating hardware running at high utilization, ideally 60% or more, with a decent margin.
And the reports really drive this point home with their sensitivity analysis.
They do. Their analysis showed that a relatively small change in utilization, say going from 40% to 70%, can change the payback period more dramatically than a 20% swing in the price of electricity.
So the cost of idle silicon is far greater than the cost of the power to run it.
Exactly. Utilization dominates the economics of the AI factory.
This utilization risk must be what's fueling the debate between the bulls and the skeptics. What are the skeptics worried about?
Three main things. One, significant overbuild or risk building for hype instead of durable demand. Two, rapid price compression on inference as models get more efficient. And three, that high energy costs will eat into returns long term.
But the bulls are clearly winning the argument for now. What's their counter?
They argue that we're still extremely early. Microsoft said enterprises are shifting from pilots to enterprise-wide deployments, which validates the spending. And that capacity is strategic. You can't risk losing customers.
Plus the classic cloud argument that efficiency doesn't kill demand, it just expands the market.
Exactly. It drives more volume. And Microsoft's recent disclosure that their AI business surpassed a $13 billion annual run rate, that puts a real number behind that potential.
So what are the signposts you think we should all be watching to gauge the health of this ROI?
I'd track four things. First, GPU utilization and capacity booking commentary from the hyperscalers. Are backlogs strong? Second, those transformer lead times. Are they shrinking or expanding?
The core physical metric.
Yes. Then third, more financial disclosures, like that Microsoft run rate. And fourth, watch for the makeshift from training, which is peak CapEx, to inference, which should be the steady, durable revenue stream.
Okay, let's move on to mapping the spend. If the bottleneck has shifted from silicon to power, where is that $1 trillion going next? Who are the new picks and shovels?
You have to focus on the companies supplying the constrained components. The thesis shifts from betting on chip volume to betting on execution for specific physical parts.
So starting with immediate power delivery inside the facility.
That's power distribution and protection. We're talking high-end switchgear, UPS systems, specialized busways. Higher rack densities demand much more sophisticated gear. It's a higher margin business.
And with 130 kilowatt racks, traditional air cooling is out, so thermal management has to be a huge beneficiary.
Absolutely. The acceleration to liquid cooling, direct-to-chip, rear-door heat exchangers is a massive driver. It's creating a permanent demand floor for these thermal solutions.
And the companies making the constrained equipment itself, that 120-week lead time must give them incredible pricing power.
It does. Which brings us to grid equipment. The transformer OEMs, the transmission builders, they're operating with huge backlogs and have amazing visibility.
And finally, the owners of the land. Specifically, land that's already permitted and has a power connection ready to go.
Yes, the digital infrastructure owners, colocation providers, REITs. That 74.3% pre-lease rate shows that power-ready real estate has become the single most powerful competitive advantage.
On the flip side, then, who are the second-order losers in this new phase?
It's anyone exposed to that utilization volatility. So uncontracted GPU capacity is a big risk. Also, commodity hosting providers who don't have a defensible power advantage.
And most critically, any project that fails the time-to-power test.
Precisely. Any large project without a credible time-to-power path is at high risk of becoming value destructive. Those transformer delays can create billions in stranded capex.
That brings us to the end of this deep dive. Let's just quickly review the core takeaways. We've seen AI capex is historic, driven by the hyperscalers. The spending is split across IT, facilities, and the grid. But the fundamental constraint today is power, thanks to extreme rack density and severe grid equipment shortages. And success hinges not on the price of a GPU, but on achieving high utilization.
And if we connect this all back, the outcomes for AI infrastructure will be determined not just by demand, how fast enterprises adopt AI, but equally by supply. And that supply is defined by power availability and grid execution. Ultimately, that tightest bottleneck, the time it takes to get a large power transformer, will likely determine which regions and which companies win the race to host the next generation of AI.
See you all in the next Pro Ticker Deep Dive.